Hello and welcome back to the Geordie Pig Investor channel. Today we're going to have a look at, is Walt Disney stock a buy right now? What is Walt Disney? Stock ticker DIS. Walt Disney is a diversified international family entertainment and media enterprise. The firm operates in 4 business segments: media networks, parks, experiences and products, and studio entertainment, direct to consumer and international. The media network segment includes cable and broadcast television networks, television production and distribution operations, domestic television stations, and radio network and stations. The firm's parking experiences includes theme parks, resorts, Disney Cruise Lines and Disney Vacation Club. The studio entertainment operation includes motion picture production and distribution, development, production and licensing of live entertainment events, and music production and distribution. Its DTC business consists of subscription services that provides video streaming of general entertainment, family and sport programming. The firm's international channels produce local program or acquire rights from its domestic studios and from third parties. Some key stats to do with Disney is that it is based in the United States. It is part of the media industry, have a market cap of $165.1 billion. They went public in 1957, have over 190,000 current employees. They have a small dividend streak of 1 year, as their dividend has only just been reiterated, hence why they don't have a 5-year dividend growth rate. Their current dividend yield is at 0.84%. Over the last 6 months, Disney stock has performed pretty poorly, being down over 21%. And today we're going to have a look at, is Disney stock a buy right now? Walt Disney earnings call and fundamental analysis. Disney reported a 2% revenue growth in Q3 2024, driven by strong IP in parks and modest moderation in demand. Domestic park revenue was flat, while per capita spending rose slightly, and in Q4 is expected to see similar trends. Disney is making significant capital investment in its cruise ships, with 3 new ships to be expected over the next 18 months. As a result of this, that is going to really increase the expenses over 2024 and 2025, but it's anticipated to boost the growth long term and is going to definitely bolster the company over the coming years. Disney secured a new deal for NBA rights, which includes the finals for the next 12 years. This reflects the growing value of live sport programming and is expected to drive substantial advertising and distribution revenue, especially over the long term. To add to this, the advertising segment saw 8% growth over the last quarter, and looking forward, Disney expects a flattish revenue outlook for the parks and experience segment in Q4. The integration of Disney Plus with Hulu, news content and ESPN is anticipated to support subscriber growth and pricing power. The company remains optimistic about its strategic direction and the value creation across its content portfolio and technological advancements. Fundamental analysis: Disney currently have a positive free cash flow at $7.9 billion. They also have exceptional 3-year revenue growth at 12%, have a positive operating income at $11.3 billion, positive growth profit at $31.8 billion, positive net income at $4.8 billion. They have good long-term solvency, low debt to equity at 0.39%, average Altman Z score at 2.03, and they do have that poor short-term solvency as we've just discussed, and also have a positive net debt at $33.6 billion. Free cash flow is the money a company has left over after it pays for all of its expenses and any investments it needs to make to keep the company running smoothly. Free cash flow is going to have a massive impact on the direction a company may be heading, and if you were to see negative numbers in free cash flow, that could be alarm bells going off in your head. Walt Disney has a very healthy free cash flow position, as highlighted in the previous slide, being at nearly $8 billion. However, as we can see on the graph, this has not always been the case in recent years. Disney went through some real tough times leading into the pandemic, and only over the last year has it really shown somewhat of a recovery. They are paying a very small dividend yield, but they have steadily increased one for over 30 years from 1982 to 2012 before they eventually cut it in 2020. They're in a very strong position right now and felt it was the right time to bring back that dividend, and you can see why with the amount of free cash flow available and with their payout ratio being as low as 11%, I'm optimistic that they may continue to increase their dividend payments at a healthy rate. Now we're going to have a look at the Walt Disney discounted cash flow valuation. The DCF valuation process calculates the present value of a company's forecasted cash flows based on a selected operating model. Disney's current price being $89. If we use a discounted rate at 7.3% and a terminal growth rate at negative 2.7%, they are valued at $52.40. By using a discount rate at 7% and a terminal growth rate at 0%, we can see that Disney are actually valued at $108. And by using a discounted rate at 6.6% and a terminal growth rate at plus 2.7%, we can see Disney will be worth $226.50. We've got a very wide variety of different amounts here. This is highlighting why specifically I wouldn't just use one method when valuing a company. I like to use multiple valuations so I can get as accurate a price as possible and I can get the average from the three of them. Next up, we're going to look at the relative valuation of Walt Disney. The relative valuation is a method used to value a company by comparing it to its competitors based on certain metrics. The metrics that I personally use are EV to revenue, EV to EBITDA, and PE ratios. These metrics can be interchanged and you can use many different ones. We can see when I plugged in my numbers, the worst case scenario, Disney would be worth $133.54, which would be an undervaluation of 33%. On the base case, it would be worth $154.15, an undervaluation of 42%. And on the best case being worth $171.30, an undervaluation of 48%. Once I have the discounted cash flow valuation and the relative valuation, I can then combine the two of them to come up with something called the intrinsic value. The intrinsic value as a stock has been used for many years to calculate stocks, and it is easily calculated by adding the two together and dividing by 2. So if we remember that Disney's current price is $89, by adding the two worst case scenarios together and dividing by 2, we can see that intrinsic value would be worth $92.95. On the average case, it would be worth $131.05. And on the best case being worth $198.90. Not only do I like to use these two methods when valuing a company, but I also like to use a third metric when coming up with my valuations for a company. The metric that I use is the Wall Street estimates. This is an average estimate of a public company's quarterly earnings and revenues that lead to a valuation of that particular company. These numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes up with what they believe is an accurate one-year price target. For a company the size of Disney, they're going to have multiple analysts working on it daily and it's going to try to come up with the most accurate price targets possible. On the worst case scenario, they believe that Disney would be worth $63.63, which would be a 29% downside. On the average case price, they believe it would be worth $113.30, which would be a 27% upside. And on the best case price, they believe it would be worth $149.10, which would be a 67% upside. Overall, now that I have our three valuations, I can combine the three together and get my average, worst and best case prices for Disney stock. When adding the three together, the worst case price came to $83.19. So by using a 10% margin of safety on this price, we'd be looking to buy at $74.89. And with a 20% margin of safety on this price, we'd be looking to buy at $66.59. Average case price came out of being worth $125.10. So with a 10% margin of safety on the average case price, you'd be looking to buy at $112.59. And with a 20% margin of safety on the average case price, you'd be looking to buy around about $100. On the best case price, it would be worth $182.30. So with a 10% margin of safety on this price, you'd be looking to buy at $164.10. And with a 20% margin of safety on the best case price, you'd be looking to buy at $145.84. So the conclusion for Disney, stock ticker DIS. Would I buy this stock right now? I think the company is at a fairly attractive price right now. This is a very well-known, worldwide recognized brand with a great fundamentals. With their heavy short-term investments likely driving their price down right now, with it being down over 20% in the last 6 months, I think that it's a good time for long-term investors to look at this company as their core fundamentals are still very strong, and I believe over the long term they will be really reaping the rewards. With the payout ratio being so low at only 11%, it shows that the dividend payment is more than likely to stay and only going to get larger year on year, which is a very positive sign for anyone who is a long-term growth dividend focused investor like myself. Just to add to this, I wouldn't have thought a company the size of Disney would be bringing back a dividend if they didn't have strong plans to continue rewarding their shareholders over the long term, as this would really damage their image and cause a lot of trust issues with their investors to bring back a dividend after cutting it a couple of years ago and then to actually cut it further. I don't think that would go down very well at all. And I don't believe Disney would want to risk that and bring this dividend back out if they weren't confident on really bolstering that dividend payment and rewarding the shareholders over the long term. Going off my valuations with a 20% margin of safety, on my average case price, Disney is valued at $100 and it is still well under that value right now, so it could potentially be a good stock to consider for your portfolio. Is it a stock that you currently have in your portfolio? Let me know in the comments section down below. I hope you enjoyed today's video. Please let me know of any other stocks you'd like to see a full breakdown on. Thanks for watching. Please like and subscribe. And this is the Geordie Pig Investor over and out.